Hello everyone, this is part 2 from freefincal, and in this video I'll talk about how to start index investing with two mutual funds or two index funds, 50% Nifty 50 and 50% Nifty Next 50 index. So I have written several posts on how active mutual funds find it very tough to beat Nifty 100, Nifty 200, Nifty Next 50 and the Nifty 100 equal weight indices. Typically, if you look at the large cap, multi cap, and then a large mid cap, ELSs, even the value funds or the contra funds, only about 50% of members in a particular category are able to beat these indices. So essentially, your chances of your mutual fund beating these indices is down to a coin toss. So it's best not to waste money on active funds and simply choose index funds. Then you don't have to worry about star rating, you don't have to worry about fund managers and so on. So but the problem is that when it comes to Nifty 100 and Nifty 200, there are no index funds available. ETFs are available, but the problem with ETFs is that there's a huge difference in price and NAV, and it doesn't correct soon. So you will have difficulty selling it when you want the money. So I would suggest not to use any Indian ETF. There are few exceptions, but it's best to choose index mutual funds. The Nifty Next 50 index is an extremely volatile index, so it's very difficult for most investors to stomach. The Nifty 100 equal weight has got two index funds, one from Principal Mutual Fund and one from Sundaram, but they have very low AUM, and many people are not comfortable about investing in such index funds. So the solution is to choose 50% of Nifty 50 and 50% of Nifty Next 50. So now in this graph I have normalized the Nifty 50, Nifty Next 50, Nifty 100, Nifty equal weight, and 50% of Nifty 50 and Nifty Next 50 movements. The red is the Nifty Next 50, which is on top. The blue is the Nifty 50, and you can see the Nifty 100 equal weight, which is the violet, and the Nifty blend, that is the 50% Nifty 50 and Nifty Next 50, that's green. They're more or less together typically, and we'll see that in more detail later. And the Nifty 100 is in black. So that's the normalized movement on price. Now let's look at returns. So the first is a comparison between the Nifty 100 and the Nifty 100 equal weight. So Nifty 100 has got the top 100 stocks in terms of market capitalization. But in Nifty 100, the stock with the higher market cap will have higher weightage. But in Nifty 100 equal weight, every stock will have the same weightage. So if you look at 10-year returns, there are about 641 10-year data points in each of those red and the black lines here on the top. 641 points here, 641 points here. And you can see that the Nifty 100 equal weight typically tends to outperform the Nifty 100 over long term. And in terms of risk, the Nifty 100 equal weight is a little more riskier. So in the bottom graph, you have the rolling risk. So that is the standard deviation is plotted over 10-year periods. Again, about 640 data points are there in each curve. And so here in terms of risk, the red line here is higher than the blue line. This means that the red line for Nifty 100 equal weight has got a little more risk than the Nifty 100. So the Nifty 100 equal weight tends to offer higher reward, but at a little higher risk, which is perfectly fine. Now we compare 50% Nifty 50 and 50% Nifty Next 50 versus the Nifty 100, and this is again for over 10 years. In the top graph, you can see the rolling returns, that the blend, the 50-50 blend outperforms the Nifty 100. And again, understandably, the blend also has a little higher risk than the Nifty 100. Now we compare this blend with the Nifty 100 equal weight. Notice that in terms of returns, there's not much difference between the blend and the Nifty 100 equal weight. And in terms of risk, well, you can't say much, because in this region, the blend is a little more riskier. In this region, the Nifty 100 equal weight is a little more riskier, and so on. So it's really not much difference between these two indices. And I think one can safely use Nifty 50% and Nifty Next 50% as a proxy for Nifty 100 equal weight. And so instead of using one index fund, Nifty 100 equal weight, you can choose two funds, one Nifty 50 and one Nifty Next 50. That is, you can choose them from different fund houses if you are comfortable with that way, and that way you are going to diversify the risk. And you can also change the exposure to Nifty 50 tactically also. That's quite possible. So now we compare an SIP that has been running in the Nifty 50, Nifty Next 50, Nifty 100, Nifty 100 equal weight and also the Nifty blend from April 3rd, 2006. So it's a current running SIP, and so it's 146 months monthly installments are over. So when it comes to the Nifty blend, we calculate returns in three ways. One, we use the Nifty blend index that we just saw the return comparison for. So that gives you 12.29%, and then we take 50% return of Nifty 50 and 50% return of Nifty Next 50, and that's the Nifty blend weighted. And then we combine all transactions of Nifty 50 and Nifty Next 50 and calculate XIRR. That's the internal rate of return. Again, that's about 12.35. So however way you calculate for the Nifty blend, the return is more or less similar, and that's pretty acceptable, I think. And if you notice, these are the returns for Nifty 50, Nifty Next 50 and Nifty 100. And Nifty 100 equal weight is about 11.36. So that's about comparable, I would say, to the Nifty blend index. So again, the conclusion is that a simple split, a 50-50 split in between Nifty 50 and Nifty Next 50 would be a simple and elegant way to start index investing in India. If you want to start doing it, please avoid all ETFs. You will get into price versus NAV differences, and please do not assume that just because an ETF has got lower expense ratio, it is better than an index fund. It is completely wrong, because people make the mistake of calculating returns and tracking error using the NAV of the ETF and not the price of the ETF. If you actually calculate returns using the price of the ETF, you will notice that the index funds tend to beat the ETF in spite of the ETF having lower expense ratio. So don't assume that lower expense ratio means higher performance in the case of ETFs. But in the case of index funds, it's true. So first avoid all ETFs, then go to value research, go to the large cap section, and then sort the mutual funds by increasing expense ratio and choose two low cost index funds, that one that tracks the Nifty 50 and one that tracks the Nifty Next 50, and invest equally in them. Rebalance the portfolio once a year so that the weights do not get disturbed. And so that's the simplest way you can start index investing in India. But if you do not want to do this, if you're worried about ditching active funds, that's fine. You can choose aggressive hybrid funds. So that there, in my opinion, the higher expense ratio is justified, because there are two asset classes and the fund manager has to, at the very least, rebalance between the two every month. Or if you want a little more downside protection, that is less volatility, you can choose a dynamic asset allocation fund, like one of those balanced advantage funds. I have recently reviewed ICICI Balanced Advantage. You can use that as well. So that's the way you can start index investing in India. I'll catch you again in another video. Bye bye.